Hey, it's Dymphna here, and welcome to my Intelligent Property Investor series. Now look, if you're new to the series, I want to explain to you why I'm putting this together, because this is a lot of content, it's a lot of information, and I'm giving it all out to you for one very special reason. Well, maybe two. The first one is that, first of all, I want you to be an intelligent, smart property investor. Now, that's all very well if you want to Skype to your friends and talk about things over the barbecue, a bit of economics. But the real reason, and this is number two, is that as a smart, intelligent property investor, you're going to make smart, intelligent property investment decisions. And that means you are going to make more profits. Because you see, real estate is a business, and the more you know about real estate, the more you know about the market, the more you know about everything to do with it, the better decisions you are going to make, and therefore the better results you are going to get. So that's my purpose behind putting together this whole series. Now, the third reason, I suppose, is that I want to talk to you about specific investment property decisions. There's a lot of commentators out there that'll talk to you about the market and the S&P 500's doing this and the gold price is doing that. This is specifically designed for property investors. It's specific data that I put together, and I'll be putting together every single week about what's happening in the market and how it affects the property industry. Not just here in Australia, but in fact around the world, because there's a lot of hype around the world. There's a lot of hype about markets, and it's going to do this and it's going to do that. Well, I hope to be able to give you some absolute little gold nuggets that you can put into practice. Now, if you make this a weekly habit, I can guarantee you, you're going to be certainly more intelligent about your decisions. And if you take action on those decisions, then you're going to be more profitable as well. So when we start to look at the markets, you might be hearing me on YouTube, on my YouTube channel. You might be hearing this on a podcast. You might be, listening to this on my website, iloverealestate.tv. Wherever you're listening to this, make it a habit, because the more habitual this becomes, the more information you're going to accumulate over time, and the better results you're going to get as a result. Now, if you're listening to me particularly on podcasts, because I'm putting this information out on podcasts as well, you'll get a lot more benefit if you jump on and see all of my charts, because as an economist, I'm putting in a lot of information and showing you the trends and what's happening and why that's important. So either on my YouTube channel or particularly on my website, iloverealestate.tv, you can jump on there. I post these up on a weekly basis, and if you subscribe to my email list, you're going to get them coming out to you, a notification, hey, there's a new one there. So you won't actually miss out on anything. So that's my recommendation for you to actually get the most out of this whole series. Now remember, because it's a series, I've done some in the past. So if this is the first one you're listening to, jump on and have a listen to the ones that I've done over the last few weeks. And because it's a series, it means I'm going to be back here next week to give you even more data on what's happening on a blow-by-blow basis. All right, let's get into the actual masterclass. So what are we going to be covering today? Well, the first thing that's really very topical at the moment is the fact that JobKeeper is ending. Now, because JobKeeper is ending, it's going to have an economic impact. It's going to reflect certain things in the market. And I'll talk about that this morning. Now, the next thing is the Chinese trade war. And I know I've spoken about this. I think it was only last week I spoke about this, but I want to talk about it again because there's some new information coming out that I think is pretty important. The next thing is that I want to talk about the housing market in other countries, particularly Western countries. And this week I'm going to feature two countries to talk about and how they compare, of course, to what's happening in the Australian property investor market. So let's get into it. All right, the first thing that I think is important is to talk about this JobKeeper ending. What impact is it actually going to have? Well, if you look at this, you can see here that we had a massive spike back in April when JobKeeper was first announced, and I think everybody was scared about what the impacts were going to be. There was a lot of uncertainty in the market, and anybody who could possibly squeeze into the regulations did and collected JobKeeper. There was a lot who squeezed into the regulations who perhaps didn't qualify for the JobKeeper, and the tax office is now putting out a massive audit squad on exactly that. So if you've been claiming JobKeeper as a business, guess what? You're probably going to get an audit. That's the information that's coming through from the tax office. Now, I said I'm an accountant and I'm an economist. So I said I'm an economist, so I'm also an accountant, which means that I'm getting all the updates as to all the data matching that's going on from an accounting perspective. So there's going to be a lot of ATO activity over the next few months as well. But economically, as you can see, this has been slowly coming down. So we're seeing, by October of 2020, we were half what we were in April of 2020, and then about half again, a little bit over, by the end of January, and we're stabilising out to the end of March. Now, the industries that are the most affected are really shown here because the blue lines are quarters 2 and 3. And how impactful that was across those varying industries, everything from arts and recreation right down to healthcare. You wouldn't have thought healthcare would have been eligible for any kind of JobKeeper, but it looks like they have been. And then the orangey coloured one is quarter 4. So that's the most recent quarter figures that we've got. And you can see there that there's been a substantial decrease in the claiming. Now, there's been some charts that have been put out here. Now, this has been put out by the ATO and the Commonwealth Bank. And what they've done is they've grouped together the information as to which industries they believe are going to be the most at risk, because when JobKeeper ends, there are going to be jobs lost. That is a fact. And they've done some estimates around what those numbers actually look like. And you can see here that transport and arts and recreation, food and accommodation are going to be the hardest hits. And that's normal. I mean, we don't have international travellers coming in. We don't have we aren't able to fly around and do as much as we were previously. So a lot of those industries are going to be hit pretty hard. Now, there's a lot of incentives coming out as well to try and buoy those industries. One of the ones that I actually disagree with on this chart is this one here. And even though it's put in here as a medium risk and it's considered to be quite small, it's the rental, hiring, all the HR and all those sort of industries, and real estate. Really? I don't see this as a massive impact at all. Might be a little contrived, perhaps, where some agents have slowed down to try and make their numbers fit into JobKeeper. But the fact is the real estate industry is going crazy. And as a result, there's a lot of activity in that space. I mean, the biggest risk in the real estate industry is the lack of listings. So maybe that's what's being reflected here. But I'll talk more about that when we get on to Australian property. Now, the next thing we have here is a chart that shows across the varying industries how many jobs they estimate will be lost. So the highest risk are obviously transport, recreation and arts and accommodation. And they have been hit hard. And anybody in those industries, my heart goes out to you because we've just decimated those industries here in Australia. Hopefully it means that we won't lose the talent that is so strong in this country across those industries, and we'll be able to maintain that talent when we get back to some form of normal on the other side, and we're starting to have all of those activities come back to full stream. Then we start to have a look at, as you see there, the retail has been hit, education and rental and hiring down there. So they're the numbers. These are the percentages across the jobs there, and what industries are going to be hit the hardest. So when we move forward from there, though, and we start to have a look at what's actually happened over the last 12 months, what we see in this chart, this really shows the fact that the worst is behind us. We have had a massive unemployment initially, obviously, but then you can basically see as those numbers have come down each quarter, and we're now right down into the 6% unemployment. Now, 6% unemployment, I mean, I'm old enough to remember when we got to 6% unemployment in previous roller coasters or economic roller coasters, we were going, wow, we've cracked the sixes. This is so good. We've only got 6% unemployment. It's just because in more recent years we've had very low unemployment. We've been down below the fives. We're shock horror that we got up to 7. But I don't know whether you remember or not, and I don't know whether you've been following me that long or not, but back in the beginning of COVID and the beginning of 2020, it was tipped that unemployment could go to 15% and possibly even 20%. Well, I don't think it even got to 20% in the Great Depression. And I think I was one of the lone voices out there saying, guys, this is ridiculous. Pull your head in. There's a lot of economic sense behind this that you need to understand. And we got to 7 point something or other. So, that really is not bad, especially when you compare us to a lot of other countries around the world. So what this chart here is showing is the flip side. So even though, yes, we're going to lose jobs when it comes to JobKeeper, there's actually a lot of jobs being created. And this is what we're seeing here. This is a chart put out by ANZ and the Australian Bureau of Statistics figures. And you can see there across the board, there's massive amounts of jobs being created, and it's increasing substantially. So this actually shows here that the number of ads being created for new jobs. And we'll just move across to the next slide here, and it tells a very similar story because this is the forecast for jobs into the future, and you can see it's going to be even stronger as we move forward. So when we look at a chart like this, now this is a chart that I showed you, I think it was last week, and it shows you how dramatically the government support has been pulled back. So the initial massive surge from, the beginning of March really was when it really started in 2020, and how much is going out in government support. And then as it comes down, we had the big drop off at the end of September, and another drop off at the end of December. It phased down from there, and we're going down to practically nothing in this support, as you can see, at the end of March. Now, overall, when you start looking at the fallout from the industries that I showed you before, there's a lot of jobs being created. And these jobs being created means that, the estimated, say, 110,000 in job losses initially, the immediate loss there, it can be taken up pretty quickly by the 30,000 that we're creating new jobs every single month. So it won't take that long for those jobs to actually be filtered through, provided people are flexible enough to be able to change industries. And that's a big if too, because a lot of people are very fixated on the job that they've got and the job that they want, as opposed to the job that's there. So, I think you're going to see some fallout around this. You're certainly going to see some media activity around it, and it's going to be a lot of hype about, I've lost my job and I used to be able to do this or whatever. But there's actually just as many other people that are going, I switched, I'm now doing this, or I can now do this kind of job or that kind of job. There's a lot of new jobs being created as well. And one of the things that I'm pretty excited about is the industry confidence. And I guess I'll just come back to this chart here. This is the job plans. So this is CEOs and they're saying we plan to have more jobs coming on. So it's not just what's there now, but it's what's planned for the future. So that's really a pretty solid story there. And it's certainly going to support the economy as we move forward. Now let's get on to the next thing. And I talked about this, as I say, last week. And this is the Chinese trade war that we've got going on. Now, I just want to emphasize again that this is a government-to-government thing. It is not a people-to-people thing. It's the big boys at the top puffing their chests up, banging their chest with their fists, going, oh, but this, oh, but that, whatever. And it's the industries that are actually getting hammered here. And I saw this cartoon during the week, and I thought I would put it up because I think this really says it all. What's actually behind this? China can get all offended about the fact that we called for a royal commission into where it started, but, we would do that regardless of what country it was. They got upset about a few things that were put in newspapers and other things, but that's the freedom of speech. People are allowed to say whatever they want in this country. But the real reason, as I see it, is we're the guinea pig in the middle. We're getting caught in the middle of the two big boys, being America and China. And it's all about human rights, South China Sea, a whole lot of other stuff that really doesn't concern us. So what is the answer to that? Look, I don't have an answer to it. I don't have a magic wand to be able to fix these things, but I do want people to chill out and understand that this is government to government. We happen to be caught piggy in the middle here. It is not people to people, so settle the hell down. On top of that, we have Chinese investment. Now, this has been reducing since 2016. It has little to do with the Chinese trade war. The main reason that the investment into Australia has been going down since at the end of 2016 and 2017 is because we stopped lending, the banking industry stopped lending to foreign investors, which at the time there was a large percentage of Chinese investment into normal old housing here in Australia, real estate. And that was causing a lot of inflated pricing, particularly in Sydney and Melbourne. So once we stopped lending to them, all of that pretty much dried up. And as you can see here, that's what we're seeing with it right down here to 2020. And a lot of the 2020 stuff is really the big boys in a lot of the bigger stock like our islands, which I'm not too keen about, but a few other bigger plays there as opposed to general housing. This chart, I think, is also pretty important because what this chart shows is how we are switching the game. So those big pink lines that you can see there are our exports to China. What a massive impact that's had. But for the first time, we're starting to see countries like Saudi Arabia coming in a bigger fashion. And this really plays on from what I was talking about last week and how when you have commodities that have a fixed demand, so not luxury items like lobsters and wine, but when you have things that have a fixed demand like, say, coal, meat to a large extent, iron ore, barley to make beer and the like. Not that Saudi Arabia is probably importing too much of that, being a Muslim country and all. But what we're seeing is that whoever... China's not buying from us now, so they're buying from somebody else. But whoever that somebody else is, whoever they were selling to previously is now out of stock. So they're going to go in the round robin and in turn buy from us in some form or another, particularly when there is a fixed demand. And there's a lot of industries where that is the case. So a lot of this political posturing that's going on really doesn't have a massive long-term impact on us. It's the luxury industries where it will have a long-term impact, and it is harder for us to branch in and get new markets. And they're the ones where there isn't a fixed demand. They fluctuate up and down and things like that. So we're starting to see a lot of pivot going across to other industries, and I thought I'd report this week that one of those pivots is into Saudi Arabia, and they seem to be coming in a big way. And you can see there they used to be big on the radar back in 2016, 2017, obviously not as big as China, but still up there. But it's an increasing market for us. Now, I thought I would just take a little bit of a pause here. I hope you're enjoying the data that I'm putting out, because in a minute I'm going to go on and I'm going to talk about what's happening in a couple of other countries. And the two countries that I've decided to feature are New Zealand and America to start with from a property perspective. But look, before I rush off and do that, I thought I'd just address something that's come up a number of times. And this is a question about how you can get access to a much higher level of information on a regular basis, and how you can actually be coached and mentored to fast track your results. So if it's okay, I'm just going to take 2 quick minutes to cover that off, and I'm going to take that as a yes. So first of all, I'm giving everybody who watches this Intelligent Property Investor series, I'm giving them the opportunity to have a 60-minute one-on-one, high-level, I love real estate, call it a coaching call, I suppose is what it is, on your particular circumstances. Now, it's with one of my I Love Real Estate advisors, and it is for free. Now, what they're going to be going through is your particular circumstances, where you're at right now, what your goals, dreams, aspirations are, and to see if coaching and mentoring is actually something that could actually help you out and get you there faster. So see if you're a right fit for the types of things that we actually do. So it's 60 minutes with one of my advisors. And what I've found with those people who've been able to take me up on this offer is they've got a tremendous amount of benefit simply by having one of those one-on-one calls with one of my advisors. So if you're interested in that, all the details are here. Because the thing that's out there, there's no one size fits all. Real estate is a business, and you've got to treat it like a business, which means you've got to have a plan. You've got to have a strategic plan to follow. Every successful country, every successful company, every successful business has a plan. It has a strategic plan that it is on path for. I mean, you do budgets, you do projections, you do KPIs, all of these things. Now, I'm not going to, bog you down with all of that kind of stuff, but something I do want you to understand is there is no one size fits all. So what that means is we need to understand you, where you're at and where you want to go, and and then talk to you about what that plan might actually look like for you. So there are 60-minute interviews, and all the details are below all of this, so that you can get the details there. Book in a call. Now I've only set a few aside for this week because my advisor's time is very valuable. So if you want one, you've got to jump on the link there and get yourself an appointment, and make sure that you log that into your diary, so that you're not wasting your time, but you're not wasting my advisor's times either. So the sessions are free currently. They may not be in the future, but they certainly are now. And I only have a handful of those appointments available to you. So for those of you listening to me on a podcast, the place to go to get those appointments is iloverealestate.tv/questions. Okay, so it's iloverealestate.tv/questions, and you can jump on there and make an appointment. I'm calling these my I Love Real Estate breakthrough sessions, because that's what it's about. It's about breaking through and getting clarity around where you are, where you want to go, and what you got to do to get there. So let's get back to the class. All right. Now, as I said before, one of the countries that I'm going to put a spotlight on is New Zealand, the beautiful, beautiful neighbour New Zealand. What's been happening over there? Wow, look what's been happening over there. I mean, this chart shows that the house prices, particularly in Auckland, but right across New Zealand, have been going vertically up. Far more even than we're experiencing here in Australia. So massive, massive increase there. In fact, they're increasing so fast that the New Zealand government is actually imposing LVR restrictions, or loan to valuation restrictions. So you actually have to have more money in order to be able to borrow to buy properties, particularly in some of the hotspots and particularly in Auckland. Now, this is something that New Zealand got very, very right back at the end of 2017, when we had all of the foreign investment forcing pricing up, and they put LVR restrictions there on Auckland. We didn't get it right in this country. We ended up with smashing the whole borrowing system to pieces, so that we're now in the process of trying to mend it and put it all back together, just to be able to get the growth that we need to be able to cover from COVID. So New Zealand got it very right. We got it very, very wrong. This is the chart of, now, seasonally adjusted median house prices. Just look at these figures. My God, look at them all. Now, a lot of these areas, if you're a Kiwi, you'll probably recognise where they are. But just to pull out a few there, we're talking Auckland jumping by 20%. Now, this is massive, 20% up. And I think, you can look at the figures and say, I'll put that on a big screen. You've got it on the big screen there, so that you're able to see see all of those figures. But when you have a look at these percentage increases, they are massive. This chart shows that even more so, because what this chart shows is how Sydney have gone, and we can see here, look, Sydney's gone upwards as well. But what we're actually seeing is that Sydney is probably about 6 months behind Auckland. So if we only get half of what Auckland's done, then Sydney's in for a hell of a run, and so too are the other major capital cities, etc. Let's have a look at what's happening in the United States now. In the United States, we have property prices increase. Now, you've got to remember when you look at these charts, I'm going to show you shortly, these charts are they're not as big as they could be, I suppose. And the reason for that is United States is not property centric. Their main go-to when we have an economic upheaval is stocks and shares. It is not property. So even taking that into account, this is what the chart is showing. And you can see there that, this compares the recovery of the property market compared to, the real GDP. This isn't property market, this is the GDP. This is the general economy. And it shows there how the blue line, how massively that has recovered compared to other periods of time and other periods where we've had a recession. So at the end of 2008, which was the GFC, you can see there long time to recover there. The early 80s, again, the black line, much, much longer, probably twice as long as it has been for COVID. The early 90s is the yellow one. Took a long time but didn't fall as deeply. And then 2001, which was the dot-com bubble, again, didn't fall as deeply but took a long time to recover. So, taking that into account, that's very encouraging, I think, is the right word to talk about, how quickly the economy is actually recovering, even in the States, where they're still going through so many cases per day of COVID and everything else that's happening. So this one shows you the net worth of households, and this is one of the greatest increases in a shorter space of time that America has experienced since the early 90s. And you can see there how vertically that goes up. So that's the net wealth. So we hear all these stories about, food stamps and how poor and the America is, and how they're struggling and all the rest of it. And look, there's pockets of that. There absolutely is. But across the board, Americans are wealthier as a result of COVID than they were before COVID. Now, the next chart actually, our next two charts are probably pretty telling. This one just shows, the household wealth and how that's increased. So that's really, that includes non-profit organisations as well. So that's the personal disposable income. So that backs up the chart that we had there before. This chart shows you how real estate prices have gone as a result of that net wealth. So you can see the blue one there, that's as at March. You can see a 5.8% increase for suburban houses. Urban general is about 2% and rural about 3.2%. So even where America is not so property centric, even there the property prices are going up. Now the next chart is going to probably sadden you to some extent. And this is typical of every downturn. It's probably where a lot of the conspiracy theories have come from and all of those other things, whether you buy into that or you don't buy into it. The reality is that when you have a downturn, the rich get richer and the poor get poorer. That's the result. So we're going to see more and more change, particularly in America, but also across the country. So this really just shows the increase that's happened as a result of COVID. You can see how pricing dropped dramatically and then how quickly it went up. But when you consider who owns the most property and who's getting the wealthiest out of all of this, it's definitely those who started with a considerable amount of wealth. Let's talk about Australia. Here we go. Isn't that a beautiful shot that I've got there for you, depicting what Australia means to us, or what it meant to me when I was putting these slides together? Okay, so what's happening in the property market? Look, this is what has happened in the property market since the pandemic started. So we've started this as at January last year. And you can see there how prices went up to about March because it was on that run of the freer lending, which was happening as a result of the Royal Commission being over and the APRA coming in and saying, it's a good time to lend now, boys, we need to get you back on board. And then we had COVID hit, and you can see what happened to pricing across the board there. So, Melbourne, Perth, Sydney, Adelaide never missed a beat. My goodness, they didn't really go down at all. And Brisbane barely went down. So Brisbane and Adelaide in this chart really show the stronger figures, and Melbourne shows the weakest figures. I think the thing to remember about Perth is it was already bashed around the ears. It was already low for a long period of time. It's only now just started to take off. So this shows you the same kind of figures, but what we're showing here is housing inflation just across the board, and you can see this goes back to 2015. And I wanted to show you here how we've kind of jumped around through to the beginning of about halfway through 2019 we started to pick up. So this period of time here between 2017 and mid-2019 was a reduction in pricing due to APRA, and the restrictions that they put on the banks through that period of time. So they killed the economy, basically, because they took the lifeblood out of the economy by restricting lending. So that's what caused this big dip here. Then we had this brief reprieve between the middle of 2019 through to the beginning of COVID, where demand, started to be met and we started to be able to buy a property again like we wanted to. And then we had COVID and we've got this massive drop off here. So, that I think that really shows a pretty strong story. So the biggest issue facing the Australian housing market at the moment, though, is the lack of listings. We haven't got enough to sell because people are just sitting on their properties. Some are perhaps still a little uncertain as to whether they'll be able to finance to get into another property. Some are a little bit uncertain about whether what their job security is. And some are very well informed and going, I'm not selling, I'm sitting on a gold mine here, I'm just going to ride it out. All of those things equate to lack of listings. Agents simply don't have enough to sell. And it's creating massive upward swings in property pricing, because if something does come on the market, people are jumping in and paying way over listing price just to be able to buy something. So this is the biggest thing affecting it. You can see the Sydney market there, massive downturn in listings. You've got the Melbourne market, same thing happening here. Then you've got the Brisbane market, the Adelaide market, the Perth market. All of them are showing exactly the same thing. So, we're going to have this big divide across the industry because we simply don't have enough to sell. So what's happening is demand is going up and up and up. Supply is going down and down and down, and we're not creating enough housing to meet anywhere near the amount of demand that is actually out there. So we're going to end up with an even greater divide between demand and supply, and the only thing that actually tampers that in the slightest is house prices increasing. And as house prices increase, the divide will start to shrink, but it's such a big gaping chasm at the moment, it's going to take a very long time for that to actually come into play. This is a couple of charts here which show the medium time on the market, and you can see there that units are definitely on the market for longer, and they're like, for instance, Sydney, 25 days on the market for a home or a house in Sydney, whereas there's 34 days on the market for a unit. Have a look at Brisbane. Now, Brisbane's a really different market here, because what we're seeing, and Darwin's a little bit similar, the housing market is very, very strong. So we're seeing, 36 days, on the market for, the average house, but the unit is taking 51 days. Similarly, Darwin, 36 days for Darwin on the market and 53 days for a unit. And I think that really tells the tale, because the more land you have control over, the better, the more upside you're going to have in the long term, because you can actually do things with it. Where you've got a unit, there's not much you can do with it. And that's why I've been so against that style of investing. If you want to live there, different story. But if it's an investment, you're going to do much better with housing if you can afford to get in. And this is the discounting that's happening. And, there's a little bit of discounting starting to happen there in Adelaide, which will probably show the fact that there'll be a little bit more of a cooling in that market, which is probably okay, because they've been so strong for so long. And a little bit there for the Brisbane, particularly in the unit market as well. So that's interesting. It's interesting to see what's happening across from a metrics perspective. And this is the vendor discounting in another format there. You can see days on the market, etc. It's just another chart that shows exactly the same thing. Now, the next thing I want to talk about here is the fact that money is cheap. It is so cheap right now. We have never had interest rates where they are. And that's the case right across the board. This is a chart that shows not just, some of the Western countries, but also like China, where their interest rates are. They're one of the strongest ones as to interest rates actually being strongly in the positive. Now, this is put out by the International Monetary Fund, but it's adjusted for inflation. So, the GDP deflator estimates. So you can see here, once we take the deflation into account, we're seeing these coming down into even the negative once inflation's taken into account. But as I said before, and this is the shocking chart that I really, really wanted to share with you, and the fact is that the wealthier always do the best in an economic downturn. So this is the sad chart that I wanted to show you here. And it's those that are in the top quartile, which is the blue one here, that are making the most money. Those on the poorer end are the ones that are, worse off compared to where they were back in 1990. You can see the big divide there, and the divide has been getting greater and greater. If you look at just this as a percentage, how much, how much above the general run of the mill, I suppose, the wealthy are were back in the 90s compared to where they are today. The divide is massive. And this is something that I want you to really, you're shocked at it? Yes. Are you angry at it? Maybe. But should you be encouraged by it? Yes. Why? Because you can be up here. You can be in that top quartile. You can be the ones that maximize your position the most. Now, we're coming into a period of time in the next 3 to 5 years where you've got a massive opportunity to take action and probably double, triple, quadruple, 10 times your net wealth that you have right now. But you're going to have to be smart. You're going to have to be an intelligent property investor. And I believe you're going to need some help with that. You're going to need coaching. You're going to need some help. So a quick recap of what we've covered. We've looked at JobKeeper ending. It's not that bad. Yes, there's going to be some job losses, but they're going to be taken up in other sectors. The trade war, yes, it's affecting things, but again, not that bad. We're madly going into Indonesia, into Thailand, into India, the fastest growing country in the world right now, taken over from China, and into Saudi Arabia, which is a little bit of a surprise. We're also looked at the housing market in New Zealand and in America, and both those countries are, in the vertical, particularly Auckland. And if we look at the correlation between Auckland and Sydney, Sydney's about 6 months behind where Auckland was. So if that's going to be the turnout, goodness me, we're in for a hell of a ride. And then, of course, the real estate here in Australia and the cheap money. So we've covered a lot of ground. And these next 3 to 5 years are going to be very, very crucial for you, which is why I'm really encouraging you to get out there and take advantage of my very generous offer of a 60-minute breakthrough session, so that we can really work out where you're at, where you want to go, and a bit of a plan to actually get there. So all you've got to do is book in one of those breakthrough sessions. They are limited, so jump on all the details. It's iloverealestate.tv/questions/. That's all you've got to do. Subscribe to my emailing list so that you can actually get these weekly intelligent property investor masterclasses are coming to you every week. And of course, the best place to get them is so that you can see all of my charts and all of my live data. So jump on to my website, iloverealestate.tv, and you can get all of those things. And I'll be continuing to give you lots more training all through 2021 to make sure that you're getting the most out of the market, because this is not a time to sit back and relax. This is not a time to dilly-dally. This is a time to step up, take action, and reap the rewards of making intelligent decisions. So that's it for me. Thank you for watching. Hope you have a great week, and I will see you next week. Bye for now.